Today is Monday, December 28th. Are we counting days anymore? Who knows? And this is a post-market review for the stock market activities today. Again, we are in this very quiet period, low volume, very low institutional participation. The market is left to retail traders to determine which direction they want to take it to. And we do know that during low volume trading days, the path of least resistance is upward. So what did we see in the market today? It is a green day overall. However, we have a theme emerging here. We saw some of the hottest names, specifically the hot retail names, declining significantly. We're talking about NEO. We're talking about Xpeng. We're talking about Snapchat. We're talking about Zoom and Peloton and DocuSign, etc. Declining significantly today. Why is that? My theory is that some smart retail money, aka the pumpers on YouTube and the kings of the Robinhoodiots, etc., they're cashing out. It is the end of the year. They made a killing. They're taking money off the table so they can pay the low income taxes before they increase, leaving many of the Robinhoodiots holding the bag instead. We also seen the big technology names such as Apple, Amazon, Microsoft, Facebook outperforming for the day. What does that tell you? It tells you that there is new yet small influx of new retail money. And where is that new retail money going? It's going to the familiar names. Remember, if you are a retail investor who's been sitting on the sidelines, you don't know anything about the stock market, but you've been hearing day after day from your friends, from your neighbors, from your relatives, how high the stock market is going every day, how much money they're making every day. When you hop into the ride at this stage, you're not knowledgeable enough to know about the Robinhoodiots names such as QuantumScape, Plug Power, etc. You will go to the default names to invest your money in. These are the big tech names, the Apples, Facebooks, Googles, etc. So we saw a combination here today of some retail money exiting the hot names, meanwhile some new retail money moving into big tech. We also saw a noticeable weakness in small caps, the IWM, when you compare it to the Qs, the Nasdaq. We will talk about this and more during the coverage of the charts analysis, so stick around for that. But for now, we do have a market to cover, and here we go. The Dow Industrial Average closing in the green by 204.10 points, or a gain of 0.68%. The Nasdaq also in the green, 94.69 points, or a gain of 0.74%. The S&P 500 also closing in the green by 32.30 points, or a gain of 0.87%. Moving on to the sector's performances for the day. Coming up at number 1 and capturing the gold medal by far, communication services, thanks to Disney, Google, and Facebook. And coming up on number 2 for the silver, consumer defensives. Number 3 for the bronze, financials. Meanwhile, the laggards of the day led up by energy, basic materials, and healthcare. Moving on to the futures market performance for the day. And right away, we see a muted session across the board. Nothing significant happened here in regards to crude oil, metals, grains. We saw some activities in grains for canola gaining over 1% for the day. I've been talking about the incredible rise in canola prices and how inflation is affecting households, specifically in cooking oil. They're all going up impulsively. The majority of the action in the futures market today happened in softs. Moving on to the big casino, the options market, and what do we see here? The hottest stable per usual is Apple. Apple has turned into a massive casino, very unhealthy, very unreliable stock. It used to be the most reliable stock in the market. Now it is becoming a pump and dump scheme due to the stock split, which lowered the prices and made the stock more accessible via options gambling instead of investing in the stock directly. And today we have seen almost 2.4 million contracts traded for Apple alone. Over 78% of those were calls. Coming up number 2, here is a new table in the casino. Alibaba. Alibaba is in a lot of trouble in China due to antitrust probes. However, the gamblers here exchanged about 750,000 contracts today alone. Over 63.5% of those were calls. Tesla, per usual, coming up at number 3 with about 670,000 contracts. The volume is a little muted per usual for Tesla when you compare it to the heat of the S&P inclusion mania. But today we've seen about 60% of those those options traded were call options. And here are some unusual activities for the day. And the first trade here is for Farfetch, the ticker FTCH. And pay attention here because this is a spread. It's a bearish one. It is a long shot one, but the trader is very smart by opening a spread instead, limiting the risk here because it is a far-fetched trade. They are buying the 55 puts, expiration date January 15th, with expectation that the Farfetch will decline over 12% by then. And they are paying about 85 cents a piece. Meanwhile, they are selling the $50 puts, same expiration date, January 15th, and they are collecting about 25 cents a piece for this one. All in all, the entry cost for the trade is reduced to about 60 cents a piece. Meanwhile, the profit potential, if this trade reaches its target, will be $5 a piece. Very massive profit margin potential here, but it is a long shot. And we do see here an interesting trade for Li Auto, the ticker LI, and they are buying the 31 calls, expiration date January 8th, with expectation that Li Auto will climb over 15% by then, and they're paying about $1 million for this trade alone. And here is another interesting one for Carvana, the ticker CVNA, and they are buying the 200 puts, expiration date January 15th, with expectation that Carvana will decline over 20% by then, and they are paying about $1.50 for this trade, bringing the total amount invested in this trade alone to over $1 million. And here is yet another interesting one for Zoom, the ticker ZM. And here we have a trader betting on a bounce for the name. Zoom been declining week after week. Remember that we called the weakness in the name a few weeks ago. And I told you that Zoom is showing a lot of weakness. Since then, the name has been declining. And here we have a trader saying enough is enough. I'm playing the bounce by buying the 420 calls, expiration date January 8th, with expectation that the name will rally over 19.5% by then, and the trader is paying about $1.50 for this trade, bringing the total over $1 million. And here is the last one for the day that I want to show you for Microsoft. Again, it is another name that I talked about a few weeks ago, and I told you that it's been dormant, doing absolutely nothing. And we have a big move coming in these big tech names that has been dormant since September. We're talking about Apple, we're talking about Amazon, we're talking about Microsoft. And I told you that my strategy is to buy a straddle on Microsoft, meaning buying a call option and a put option for the same strike price for the same expiration date. And if we have a large movement one way or another, the trade will become very, very profitable because the options were extremely cheap at the time. And since then, we have seen Microsoft and other big tech names moving higher, making the straddle strategy very, very effective. And here we have another trader betting on more upside from Microsoft, buying the 242.5 calls, expiration date February 5th, with expectation that the name would rally over 8% by then, and they are paying about $2.70 for the trade, bringing up the total well above $1 million. Moving on to the headlines that shaped the day. And right over the weekend, we have seen the art of the cave. Because Donny Boy has been barking and threatening to veto the bill, choosing the people's side, saying that $600 is ridiculous, and unless they pump it to $2,000 per person, I'm not signing the bill. What do you know, over the weekend he said, changed my mind, I'm gonna sign the bill anyways, and then you guys do whatever you want to do. Who gives a shit about this presidency anymore? I'm going back home in a few weeks. And here we go, breaking news after the bell. We have the House voting to pass the increase of the stimulus from $600 per person, which is absolutely pathetic, to $2,000 per person. And now that goes to the lap of the Senate, specifically Mitch McConnell. Remember that Nancy played her cards very badly before the elections. Donald Trump gave her about $2 trillion stimulus deal. That includes local funding and includes $2,000 stimulus checks. Nancy said no thank you because she wanted to win the elections. She wanted to make Donald Trump look bad heading into the elections so he can lose, and she made all her bets that she will win the House and the Senate and she will be able to pass even larger bill. That didn't happen, and now Nancy's trying to do some repair work and play her cards in another way this time around. She's saying, okay, Mr. President, you want $2,000? We'll make it $2,000. Here is a ratified bill that increases the $600 per person into $2,000 per person, but we're gonna stuff in some additional things that we want as Democrats, and we will leave it on the lap of the Republicans on the Senate to look bad if they reject the bill, meaning that Nancy's now playing her cards right. She's saying, you want 2,000? I have no problem with 2,000, but I'm going to write a bill where I'm going to put additional things beside the 2,000 that you guys, Republicans in the Senate, don't like, and I dare you to vote against the bill. I double dare you. We will see how Mitch is going to play this one because he is in a tough spot right now. If he rejects the bill, he will look bad, solely bad, because Trump and the Democrats want $2,000 stimulus, but Mitch doesn't. What does that mean? It will hurt the runoff elections in Georgia in a few days, meaning that if I'm playing the odds here, I am betting that Mitch McConnell will fold and he will pass the bill. But it is not about Mitch or Nancy. It is about the people behind those politicians. And to get a little teaser, a little taste on who is behind those politicians, let's talk about a former one who was a Treasury Secretary before and the biggest crook ever existed, Larry Summers, who took his orders from Wall Street and the billionaires when he was in charge. And Larry Summers, the psychopath that he is, argued that $2,000 and even $600 of stimulus is very, very dangerous and unwarranted because it could result in overheating the economy. No, I'm not kidding. Take a listen to the psychopath himself.
I don't think the $2,000 checks make much sense. The real issue is going to be sustaining this expansion. If you think about it, the 908 stimulus bill probably would pay out $200 to $250 billion a month for the next 3 months. The level of compensation is running about $30 billion a month below what we would have expected it would. GDP is running about $70 billion a month below what we would have expected it would. So in a way that's quite unprecedented, we have stimulus already much more than filling out the hole. And given that lots of the hole is from the fact not that people don't want to spend, but that they can't spend because they can't take a flight or they can't go to a restaurant, I don't necessarily think that the priority should be on promoting consumer spending beyond where we are now. So I'm not even sure that I'm so enthusiastic about the $600 checks. And I think taking them to $2,000 would actually be a pretty serious mistake that would risk a temporary overheat.
And of course, Larry Summers caught a lot of shit on Twitter. Everybody attacked him. Republicans, Democrats, progressives, regressives, everybody. And Larry Summers, of course, issued this tweet. To those who say 2,000 checks, not optimal, but better than nothing. What is limiting principle? How about 10,000 checks? More? ? Hard to justify support for near universal giveaways with income losses fully replaced with no liquidity problem for most. And he is linking a study from the Landromat, J.P. Morgan Chase. Now this asshole lives in a world of his own in the billionaires bubble. He has no clue how Americans are suffering right now. He hasn't seen the lines in food bags. He thinks that every income and wages lost were replaced, according to him. Meanwhile, we know from the data that I present to you every single day that Americans are experiencing loss in income in every single state. Their consumer spending power has been reduced significantly, and a lot of them under threat of being evicted very, very soon. And by the way, to this absolute monster psychopath, Larry Summers, you are so worried about $2,000 stimulus checks to the people due to the risk of overheating the economy, but you were not worried about the trillions of dollars that the Federal Reserve threw in helicopter money to corporate America. You were not worried about the very elevated stock market prices that are in dangerous and extreme bubble territory. That is not risky to you. You don't see an overheated economy there. But God forbid, helping people who are in need, that might overheat the economy. And this goes to illustrate the psychopathic tendency of these economists who are leading public institutions and the government, specifically the Federal Reserve. When they talk about inflation, they don't measure gas prices or food prices, which are the most relevant prices to you and me because they fluctuate too much. You cannot measure inflation based on canola oil prices and soybean oil prices and rice, etc., which has been increasing significantly every single day when we have Americans suffering and stealing food to live. They're resorting to go to the grocery store and stealing food so they can survive. But the Federal Reserve measures inflation based on, say it with me, wages. God forbid your wages increase, the Federal Reserve has to put a limit to that because the risk of overheating the economy. Are you starting to realize how psychopathic these animals are? They don't want any improvement in your life. Moving on to some market sentiment news. And let's talk about the hyper bullish sentiment in Wall Street right now. Here is the headline from Bloomberg. Gravity defying market finds rationale in bullish profit views. Now that we have exhausted vaccine optimism, stimulus optimism, Brexit optimism, federal cocaine optimism, scratch my nut optimism, we have to resort to, here it is, corporate earnings optimism, which is the worst place to place your optimism in because analysts have increased their 2021 EPS forecast for 10 straight weeks. Meanwhile, the Citigroup Panic Euphoria Index jumps to an all-time high, higher than the dot-com bubble, meaning that some of these stock valuations are pricing every rosy view about an increase in revenue and profitability, etc. They're pricing, in certain cases, over a decade of growth already, meaning that this insanity, this euphoria that's going on in the market, and now we're talking about, profit optimism. Forget about it. The profits are already priced in, and the market is now at a risk that any disappointing news, any misses in earnings, any hint of bad news in corporate results will cause crashes all over the market. You will see stocks dropping 10, 20, 30% after reporting earnings. When you talk about the risk versus reward, it is on the side of taking profits and foregoing this mania and euphoria. Nothing, I repeat, nothing will support these current elevated prices. If anything, corporate earnings will expose how elevated these prices and out of touch and out of reality they are. And we see that the mania has surpassed 1999 levels. When we talk about the percentage of IPOs of companies that are actually losing money, we are way worse than the dot-com bubble. Furthermore, we are seeing a significant uptick of retail traders invading the market, way bigger than the dot-com bubble. It is the largest influx of dumb money into financials markets that we have ever seen. Take a guess and think how this story will end. And to give you a little clue here, let's talk about Chris Sacca, because Chris Sacca warned on Twitter, he warned the Robinhoodiots and the new retail traders to take their profits before it's too long. And here it is, the exact tweet. To everyone who got into trading stocks this year, I have a little hard truth for you. You're not actually that good at it. You just caught a wild bull market. Take some profits off the table. Now, do you think that the Robinhoodiots are smart enough to listen to Chris Sacca? No, they're not. The Robinhoodiots is a very uneducated, dumb money crowd that got lucky, but they are very greedy and they're very, very arrogant. And they keep saying that this generation is the smartest generation and the most educated generation. I say it is the dumbest generation. You know why? Because they have access to the internet and all they have to do is Google what happened during the dot-com bubble. Google the quadrillionaires who invested in Qualcomm and became millionaires overnight, and they were bad-mouthing Warren Buffett, calling him too old, and saying that they are the new Warren Buffett. How many people do you know today that say, oh, I made my profits and my wealth during the dot-com bubble? None. The only people who kept their gains from the dot-com bubble are corporate insiders and the entrepreneurs who pushed these useless IPOs in the market. The geniuses, who I call the dot-com bros, those are the predecessors of the Robinhoodiots, kept bragging day after day, month after month of how smart they are. They figured it out and the market can never go down. It's a new revolution, bro. The internet. They quit their jobs. They started buying luxury cars. And what do you know? The whole party came down crashing on their heads. Did they even see it back then? No. They saw that this is a dip to buy, burying themselves even further. Because we know that after 2000, the Nasdaq started to decline significantly, erasing all of the gains from the dot-com bubble. But here is the new generation. We call them the Robinhoodiots, who are going to meet the same fate. Are they listening to Chris Sacca? No, they're not. Here is a Robinhoodiot. LOL. Dow's only up 6% this year, yet it was a quote-unquote wild bull market. And that even ignores the fact that 2020 had the first bear market in 11 years. Take profits? Sure. But vaccines, plus Biden presidency, plus reopening, plus normality are going to propel markets 30% higher in 2021 and 2022. Now take a look at this guy and guess where he was during the dot-com bubble. Chris Sacca was an entrepreneur back then. He knows exactly what happened during the dot-com bubble. This Robinhoodiots was probably in his diapers. But somehow he knows more than Chris Sacca. He was more. Oh, I'm supposed to quit because that guy says so? Bro, I'm betting on myself now. I'm not betting on being a slave to the corporate machine anymore. You moron. You're gonna go back to corporate slavery in the worst manner because all of what you've done in 2020 is grow this plant that you call gains and financial freedom. But in 2021, you're going to realize that you've been growing this plant for Wall Street insiders to snatch from your hand, say thank you very much for making me richer. Now get back to work. Because what happens is, while you're watching your quote-unquote gains go to the moon so you can quit your job and have financial independence, Wall Street insiders are dumping stock like never before, taking your dumb retail money, becoming richer in the process. Then they will crash the market in your head. You're not going to see it coming. You're going to lose everything. Meanwhile, they will use the cash they raised from you to buy stocks back at cheaper prices and ride the ride over again. The only difference here is you are not going to be in that ride anymore. You're going to go back to corporate slavery, you moron. Here's another one. Agreed 100%. We are lucky to be in the right place at the right time. But the harder we work, the more we study, the luckier we get. Okay, let's see how this one is going to end up for you. Keep studying, bro. Is there anything to study here besides stocks only go up? You don't need to study anything, bro. Just put your blindfold on and continue to buy call options. Here is another one. Thank you, billionaire overlord, for gracing us poors with your wisdom. Okay, continue to hand your money to the billionaires. This is one billionaire who's trying to save your ass, you moron. I'd love to see these people in a few months from now when they crash the markets in their heads. The billionaires are loving your participation in the stock market because it makes them richer. They're cashing out. Jeffrey Bezos cashing over $10 billion this year. Mark Zuckerberg, over $1 billion this year. The Walton family cashing, we're talking liquid cash here, over $1 billion bucks. They're all raising a significant amount of cash that dumb retail money raised for them. Nick, whatever your name is, be careful here. There's one billionaire looking for your ass. His name is Chris Sacca. and instead of listening to him, you're bad-mouthing the guy. Oh, and by the way, let's contrast these comments with more experienced traders and investors. Here is one, and she's saying, I was doing investor education writing at the NASDAQ in 1999-2000. Every day at closing, complete euphoria, all based on speculation. I asked the VP if she did not see historic comparisons. She scoffed, saying a crash like 29 could never happen again. Shortly after, the bottom fell out. Here is another one. Feels similar, doesn't it? I have managed money professionally since the mid-80s, and to Chris's point, I can't recall another time when young pros who've never seen a bear market coming on 12 years now, let alone novices, have been so confident in their daily victory laps. To the first moron commentator who says, oh, we have seen a bear market. You have not seen a bear market, bro. That was just a mere correction that happened after the crash of February. You're gonna see a bear market. Just wait for it. And let's see how confused you're gonna be trying to trade a bear market. And here was another one. In 1999, I was day trading and making a killing. He was a guy who was probably a Robinhoodiot back in the day, but he grew older, became more experienced, and now he's sharing his story. Everyone wins in an up market. Just wait for Judgment Day. Or shall we say, just wait for Judgment Day. It will happen. It will be a sharp decline. You buy in the dip, thinking tomorrow will be up, then it drops again and again and again. Exactly Robert Willis, whatever it is, he knows from experience what happened there. After the crash in March, the equivalent of the Robinhoodiots who've been bidding on .com names thought it's a dip to buy. They continued to buy the dip over and over and over. What do you know? The market continued to go down and down and down and every single day. Just like we were going up and up and up these days, every single day on fill in the blank optimism, there will come a day very soon when the market continues to go down and down and down, even though we're hearing good news about the economy every day. But it is now fill in the blank pessimism. And back to Chris Sacca. Of course, he had enough from the Robinhoodiots. He tried to offer advice. They did not listen. They bullied him. They attacked him. Who's Chris Sacca? Who is this moron? What does he know? This amateur. We the Robinhoodiots, are the new Chris Sacca. We know better than Chris Sacca. Look at my gains, bro. Want to see my Robinhoodiot account? And Chris Sacca said to the angry Robinhoodiots bros who got into trading stocks this year, I was wrong. You're amazing. This has nothing to do with the market. It is all about you and your mad skills. Don't take profits off the table. Double down on margin. Borrow everything you can. Stocks never go down. Exactly, Chris. Leave them alone. I've been trying to convey them day after day doing this daily show to take their profits, that stocks don't go up all the time. This is just a lucky streak that you're in. You had the perfect beginning investing in the stock market. Now you need to transition to how you can stay in the game for the long term. Do you think they're listening? No, they're not. They attack me every single day, calling me a loser, a perma bear, etc., etc. The best thing we can do here is just grab a big bag of popcorn and wait for the slaughter to happen. And I know what they're gonna say, the Robinhoodiots. But this time is different. But the Fed. But the interest rates. You know who said that back in 1999? The same exact argument that you're making today. Interest rates will never go up. They're gonna continue to go down because of the maestro. Remember the maestro? You probably don't, because you weren't even born then, or you were in your diapers. But somehow you're a stock market expert all of a sudden. Here it is. This Christmas, Wall Street is partying like it's 1999. Is it really different this time? We're being told, quote unquote, this time is different. Most of the skeptics in finance I know have now capitulated. Yale University finance professor Robert Shiller, who earned a Nobel Prize by pointing out that over time the stock market tends to follow the progress of corporate earnings. Duh, he won a Nobel Prize for saying the most obvious thing ever, has now decided that this time is different, right? This genius who won a Nobel Prize is now becoming part of the Robinhoodiots. Because of low interest rates, legendary investor Sir John Templeton used to say that quote-unquote this time is different were the four most dangerous words in investing. Continuing, meanwhile, faith in the Fed is unbounded. Back in 1999, it was so-called the maestro, Alan Greenspan, who was going to keep stock prices rising indefinitely, no matter what happened. A lot of you younger investors do not remember this at all. But in 1999, what caused the irrational exuberance is the fact that retail investors put a lot of faith on Alan Greenspan that he will never let the stock market go down from here. Turns out that the Fed's capacity to prevent bubbles from popping is very, very limited. And you're going to find this out again with Jerome Powell, who's even a duller and dumber Fed Reserve Chairman than Alan Greenspan. Today, it's the Fed under Jerome Powell, which has flooded the market with unprecedented amount of money to keep things going. Clearly, this can go on forever, right? And to answer this question, here is the article from the Wall Street Journal to illustrate to you why this crash will be of biblical proportions. It will make the 2000 crash look like a blip on the radar. Investors doubled down on stocks, pushing margin debt to record, chasing bigger gains. Some have exposed themselves to potentially devastating losses through riskier plays, such as concentrated positions and trading options. This is what I've been calling the domino effect. When we have a correction, it will start by 10 to 20%, the usual, but it will morph into a crash of biblical proportions due to the risky behavior of margin borrowing and options gambling. You will see a crash like you have never seen before, and I'm willing to bet my house, my life, that some of these prices in these stocks that you're seeing today will never be seen again for at least 5 years from that point. Meaning that if you buy some of these stocks at these prices, you will be holding the bag for at least 5 years, if not longer. Remember that the bag holders from the year 2000, the top of the dot-com bubble, been holding the bag for over 20 years in some instances. Moving on to some corporate specific news, and here we go. Did you guys catch the new Wonder Woman movie? Neither did I. Are you excited about it? No, you're not, and so am I. But here it is. Wonder Woman 1984 earns just $16.7 million in theaters, which is a record for box office performance during the pandemic. Yet the movie is available to watch if you are a subscriber of HBO Max. Now, this strategy is a bit experimental, meaning that a lot of these streaming services, whether it's Netflix, AT&T, Disney, they're now betting that the theaters are dead, and the way for growth is to accumulate as many subscribers to the streaming service as you can and generate billions of dollars a month instead of taking the risk of releasing movies to the theater and making a gamble whether it's going to be a hit or a bust. That is good for the corporations, but it's not good for producers, for writers, even actors, because a lot of these superstars used to make their wealth from capturing a percentage of what the movie is going to make in the box office. Well, if movies are going to be released to the streaming services for free, meaning that these superstars were just going to get paid before the project, and that's it. Meaning that the era of the super celebrities, we're talking about Tom Cruise and Brad Pitt, etc., that is coming to an end. And the movie business will change forever. Moving on to Alibaba, the whole fiasco that happened last Friday in the Hong Kong market, and we saw a subsequent decline of over 16% in US trading for Alibaba. Well, now Alibaba is trying to soothe some of the concerns by saying that they will raise the stock repurchasing program from $6 billion to $10 billion. So please do not sell your Alibaba shares. This is, of course, what Alibaba executives want you to think. The reality is that China as a system is rethinking the whole billionaires thing, allowing entrepreneurs to become very powerful and have an enormous amount of wealth comes with making these people very, very powerful. Powerful enough to challenge the system, aka the Chinese Communist Party rule. And all what Jack Ma did is just a slight criticism to the regulatory system in China, and he is getting punished severely. And I think that China is going to rethink its strategy of allowing these individual entrepreneurs to become extremely wealthy. They will either need to have some sort of loyalty test that these entrepreneurs will remain loyal to the CCP, or they're going to have to forego the system altogether and limit how powerful and how wealthy these individual entrepreneurs are going to get. This is a recipe for disaster in investing in Chinese stocks. We're talking about NEO, we're talking about Xpeng, we're talking about JD, etc., etc. Because what guarantees do you have that the Chinese company you're investing in is not going to be the next target of Chinese regulatory authorities? You don't know that, and this is why I keep avoiding investing in Chinese stocks. Moving on to Apple and the iCar. Here is the headline. If Apple makes a 75,000 electric vehicle, here is how it would affect its bottom line. And just to give you a little spoiler alert, it is not good. Here it is. Assuming Apple could grab 5% market share of the electric vehicle market with 75,000 iCar in 2025. That sports a 7% operating margin. The tech giant will only see a 3% bump in earnings. If Apple sells its electric car for $100,000 each, it snags 5% of the EV market and drives 10% operating margin. Hall estimates the bump to Apple earnings would be just 5%. Not too impressive for Apple, given its much higher margin structure currently driven by making less capital-intensive iPhones, iPads, and Macs using outside suppliers. But the somewhat subdued earnings accretion from an iCar, as Wall Street analysts call it, reflects the costly nature of making an electric car, or a car of any kind. See low single-digit percentage operating margins at Ford and General Motors. Even Tesla is not profitable from making cars. It is profitable due to the environmental credits. We believe that a car makes sense for Apple as a hardware platform supporting its services, but the lower profitability of the auto business likely means that investors would see limited earnings impact from such a move, meaning that Apple is about to dip its toes in a very, very difficult market of car production. A, it is very capital intensive. B, it is not a high margin business, meaning that the investment versus the returns is not worth it. And if we were in any rational market, investors would have punished Apple shares, not rewarded. But we are in the video game market, we are in the Robinhoodiots era, and we are in irrational exuberance 2.0. So good news is good news, bad news is good news, worse news is even better news. And Apple dangling a shiny object like the iCar will push valuations higher, not lower. And here is the last bit of news I want to share with you. Due to the rise of Bitcoin over the weekend, Bitcoin is irrelevant to financial markets, and investors are going to weep if regulators come down hard on crypto, says Kevin O'Leary, the Shark Tank guy. Now, let's ask Mr. O'Leary, what would he suggest as an investment beside Bitcoin, since he doesn't like it? And the answer is, from Kevin O'Leary, is invest in my garbage ETFs. Why? Because he wants to collect cash from your dumb retail money. Retail money is being dangled all over the place, with retail traders and investors saying, hey, I got some cash. Anybody wants to take it? And you have all these sharks trying to exploit the opportunity and take your dumb retail money to become richer. Please be smarter than this. You worked hard to make your money, invested right. Don't just make money, but learn how to keep it. That is the most important skill for retail investors to learn. Moving on to the heat map analysis, and we are gonna go a little quicker here because we're running out of time. Right away, what do you see as a theme today? Big tech outperforming. Apple up over 3.5%. Microsoft 1%, Google, Facebook, Amazon, all outperforming, along with Disney, which is becoming a very ridiculous rally at this point. What is being punished? The hot names. We're talking about Palantir, down over 6.5%. We're talking about CrowdStrike, down almost 4%. Okta, over 4.5% to the downside. When we talk about Shopify, down over 6%. Snowflake, similar story. Trade Disk, over 10%. DocuSign, over 6.5%. Workday, down over 3%. Unity Software, over 5%. Zoom, down over 6%. Airbnb, over 3.5%. Snapchat, over 3.5%. DoorDash, down over 6.5%. You see the picture. You see what's going on here. And as we move on to more hot names in the consumer cyclicals, let's take a look. Carvana down over 8.5%, almost 8.5%. NIO down big, over 3.5%. Lee Motors down over 7.5%. Xpeng down almost 10%. When we move on to another name in the list of retail favorite names, Moderna. Moderna down almost 10% for the day. What does that tell you? Along with a lot of biotech names, by the way. What we have seen today is profit taking from the smart part of retail. They're saying, okay, we had a really good year. It is time to ring the cash register and take the profits, pay the low interest tax rate, keep the cash, wait for the correction, and then hop in again. At the same time, you're seeing a new influx of money into big technology names by buying either the individual stocks, say Apple in this case, due to the iCar optimism, or via buying ETFs such as the triple Qs directly, which will push the bigger names, the bigger tech names higher. We will see how consistent this theme is. And if I am right, we will see a tsunami of selling of these very hot names because somebody pulled the trigger today, somebody else will pull the trigger tomorrow, and then we start to accelerate to the downside severely, triggering margin calls. We could see that these hot names having a correction of their own while the market overall continues to hold steady slightly to the upside. And by the way, that would be a very good move for the bulls because doing the correction this way, when you flush the excesses from these hot names quietly, that will avoid the inevitable outcome of an overall market crash. At least it will soften the blow of that particular correction or crash, whatever you want to call it. Moving on to the rotation trade. And I want to show you that today was not rotation out of the rotation. The rotation trade is still well and alive. Today was just profit taking of the hottest names, in addition to switching some money, new and old, into big technology names. Right away, when we look at the stay-at-home stocks, we see Facebook outperforming, Google, Apple, Amazon, the big tech names outperforming for the day. What is not outperforming? Zoom, DocuSign, Peloton, Shopify, the hottest names being sold for money and cash to be raised. What about the reopening stocks across the aisle? They're holding steady. We see significant gains for Ulta Beauty, Live Nation, TJ Maxx. We saw a little bit of declines here for Planet Fitness, which been outperforming for a while now. We're not seeing a rotation out of the rotation. Yes, the IWM underperformed today, but the rotation trade is still well and alive, evident by the performance of Live Nation today. Moving on to the charts analysis, starting with the SPY 15 minutes chart. What do we see here? It is a gap overnight when they realized the retail traders are not going to pick up the tab and push the market higher. Because retail traders are already all in, they have to pump the market overnight. And now we are at pretty much all-time highs in the SPY. Now, a lot of bears are going to look at this chart and say, what about the double top? Are we going to see a double top? Too early to say. But for the double top formation to be confirmed, you're going to have to break the support level of 369.60. Absent of that, you cannot put a lot of validity into a double top formation right now. If anything, the chart is bullish. Switching to the SPY futures, we are still battling the upper limit of the range, trying to break above it. This is bullish behavior, gathering energy to make the final blast to trade above the upper range. Until and unless we break the support level of 3,600, we're not going to be bearish and shorting this chart at all. What about the Qs? 15 minutes chart. Again, it's a gap higher, outperforming the rest of the market today. There is nothing to see here in the Qs. The sky's the limit. You see the yellow trend line. Until we break that line and we break the support of 308.50, we are not going to turn bearish on the Qs just yet. I am bearish in the overall market regarding sentiment and valuations, but when you look at the chart, you have to treat it as is. What is the chart telling me right now? The chart is saying everything is clear. Everything is bullish. Do not short this market yet. If anything, you ride the wave higher. I have to be very transparent and honest with you when I do reading these charts. Until and unless we break below the level of 308.50 and we break the support line, the trend line that is, and preferably break the second support line of 303.35. I will not consider that as a reversal until we do that. And then I will place a short on the Qs and perhaps the market overall. Now here is the IWM. 15 minutes perspective. What do we see here? You see that the upper limit of the range has been working perfectly day after day, session after session. So what did they do today? They said, okay, retail is not going to get us above that level yet. So let's do an overnight pump. They do the overnight pump. And what happens is, contrary to expectations, traders started selling the IWM and it had a pretty bad close at the end. Can we read anything from it besides it is just a weekday? We cannot. We cannot say this is a reversal. We cannot say this is a shorting signal yet. We need to break below the lower limit of the range and break the support of 191.50 before we turn bearish and we place a short against the IWM. That doesn't mean that I don't have bear FOMO just like you and trying to play and call the top ahead of time. I tried twice by buying the TZA and I got my stop loss order triggered twice. So perhaps third time is the charm, but the third time I'm gonna wait until we break or it looks for certain that we're about to break the 191.5 support line. And then I will go in heavy, this time buying the TZA. Moving on to the dollar index, what do we see here? We see somewhat of a bull flag formation. The resistance line remains the 90.5 points, and I am betting that the oversold rally in the US dollar is not finished yet. I think we're gathering energy and we will blast higher, creating another rally in the US dollar. What does that mean for gold? It means that gold could fail the support line of 1870 and drift lower if we see a rise in the US dollar. It is the battle between gold and the US dollar. Will the bull flag formation in the US dollar play out, or will the reverse head and shoulder formation in gold play out? One of these is going to win. There's a very rare scenario where both are going to win. We're not going to discuss it because the likelihood is it's not going to happen. Either the US dollar blasts higher or gold will blast higher and the other will decline hand in hand. Now let's take a look at yields, the TNX, and see what's going on. We are marching closer and closer, gathering a lot of energy here to crack above the 1% level. There are two certain things in life. Number one is death. Number two is the yields will close above 1%, regardless of what Papa Jerome has been saying. Moving on to the VIX, what do we see here? We pretty much erased the entire move from last week. The 30% pump last Monday has been erased, and now we are in a critical level for the VIX. Either the VIX is going to pop tomorrow and show us that it is not ready to subside yet, or we will see significant weakness here in the VIX going back to the lows. And you know that my line in the sand is at 20 level. If we break 20 and close below it from a weekly perspective, that is an indicator that we have another melt up rally happening in the market. So tomorrow is a critical day for the VIX. This is the one chart that I'm watching tomorrow. I'm not doing a lot of trading these days, not even watching the market a lot, but I will be watching the VIX tomorrow and see how it behaves. It will be a critical day for the VIX, a put up or shut up kind of day. Now, let's move on to Apple from a weekly perspective. And let's go back and hear what I said in late November about Apple. Oh, and here is a weekly chart, and I'm about to confuse you just a little bit. Are we seeing a bull flag formation for Apple? Apple been consolidating, lagging the market. Are we going to see a breakout to the upside for Apple? If my theory is correct, and we're going to see a rotation of the rotation this upcoming week, where traders are done with the holidays names and Thanksgiving names such as Macy's, retail, banks, energy, etc., all the cyclicals. If they're going to dump that trade, we're going to see a decline in the IWM small caps. Will that money shift back to technology? I think absent of a catalyst that would scare the market overall and cause an overall correction with the Qs, the SPY, IWM, everything declining, I think that the money will shift from the IWM, taking the gains that happen very fast and quick, moving them back to technology, and Apple could be a gainer this upcoming week. And Apple exactly performed as I expected, outperforming the market since that call. It is up over 16% week after week, outperforming the market significantly. We did not see a definitive rotation from the IWM and the reopening trade to the Qs. We have not seen that yet. but we did see the inflow back into Apple and big tech, moving them out of the dormancy they've been at since September, specifically for Apple. Now, here is the last chart of the day for Tesla. Remember, I told you that the break above the upper limit of the range is a fake out, and we are going to go back and try to break that upper limit of the range organically, not via the quad witching S&P 500 inclusion move. And this is exactly what we have done. We went below the range, the upper limit, and we tried again. And today was Tesla trying to give it a shot and break above the upper limit of the range. So what happened? We had a rejection and we saw Tesla closing lower. Here's the critical thing to remember in Tesla. Tomorrow will be a very important day, not just tomorrow, but the entirety of the week, because we need Tesla to either give it a shot, another one, and close above the upper limit of the range, or was that all there is? We had a rejection today, tomorrow we trade lower, and then we trade another day lower, and that would be it. How would we know? Again, the break above the upper limit range is obvious, but how do you know if Tesla's turning bearish and you need to take your profits or even short the name? If we see a reversal and a breakage below the important level of 599. It will become abundantly clear that we're about to break the 599 level from how the stock will react as soon as tomorrow. So along with the VIX, I am watching Tesla chart very closely. And now let's move on to conclude this video with answering viewers' questions and answers. And here is the question. By far the best market channel. Thank you, Mav. I really appreciated the different kind of show last night. It was very well done. Would be great to see something new, informative like this once in a while, so I can keep learning. I have more material for you. It's coming out very soon. At least 4 to 5 videos that I have for you that would be 100% for educational purposes. But here's the question, continuing. I am still not confident in my skill level for options. So looking at inverse ETFs, instead of averaging down my buy price on an inverse index, I have the UVXY. And he is, of course, talking about a mistake buying the UVXY. Remember, I always advise against buying the UVXY. But the question here is, in essence, do you believe in averaging down? Let's say if you bought an inverse index and now you're holding the bag, do you believe in averaging down or diversifying? Meaning that if you had the UVXY, you're going to go ahead and buy the SQQs or the SDAO, the TZA, etc. Continuing with the question, one thing that was not mentioned in your show last night. I read many inverse ETF message boards post that fear of decay and reverse splits on all of these inverse ETFs. Although a real concern during this volatile time in history, should this give any more or less pause when considering what I mentioned above? Thank you. So let's answer this question one by one. As far as averaging down, when you buy these inverse indices, you're buying them as a hedge against your long portfolio. If you're not buying them as a hedge against your portfolio and you're just buying them expecting a downturn in the market, you gotta have a thesis. You gotta have a theory here of how much the market will decline and when. And if your theory is wrong, you have to exit the position, because as you've mentioned, you will see a lot of decay. These inverse indices are designed to lose value as the indices they're pinned against appreciating value. For example, if the triple Qs gain in value, the short triple Qs, the SQQs, will decline in value. And this is why I always say, when you're gonna buy inverse indices, you have to place a stop loss order, because that will prevent your losses from morphing and snowballing into more losses if your theory and your timing is wrong. Furthermore, if you're gonna hold these inverse indices and you are not gonna average down via using options, meaning selling put options and selling call options during pops, it is a very bad strategy to hold them indefinitely, for the same reason of quote-unquote decay. These inverse indices are designed to be bought in a certain time period and to be exited once that time period is done. Meaning, if you're anticipating a correction, this is the time to buy an inverse index. But you have to have a theory. You have to have a thesis of why you're buying this. And that goes to answering the second part of the question, whether you should average down versus diversifying. The problem with diversifying, meaning you bought the UVXY, now you're holding the bag, and you think of buying the TZA or the SQQs instead. You're playing a losing game here because there's a lot of redundancy, and if one market is not going down, that means that the likelihood that other markets will hold steady as well, meaning that you are just digging your grave deeper and deeper by quote-unquote diversifying into other inverse indices. For example, my thesis now is I see a decline in small caps, the IWM. It is technically extended, it is overbought, and we are seeing this sort of a rotation back to big tech, meaning that I will buy the TZA and have a specific stop loss order when I place the trade. And if we do see a decline in the IWM in the next 2 weeks, that is my time period that I'm giving the trade to work. If we do see a decline, you will see my investment in the TZA appreciating significantly. That is my thesis. What I'm not going to do is buy the TZA and the SQQs and the SDAO. That doesn't make sense at all. You gotta have a specific thesis, specific entry strategy, specific exit strategy if you're wrong and when you are right as well. So in summary, is averaging down, holding these inverse indices for a long period of time and averaging down, is that a smart strategy? Only if your thesis is still intact that we are about to see a correction in whatever specific market you're shorting and you're using options to average down, meaning you're selling put options, getting paid to average down. Other than that, it could be a recipe for tragedy. Furthermore, if you're holding the bag, digging your grave deeper by diversifying and buying other inverse indices is also a recipe for disaster. Always have a thesis why you are buying the inverse index. Are you using it as an insurance policy against a long portfolio? And if that is the case, what is your time limit? Where and when do you see the correction happening? If you're just buying an inverse index to play a correction to the downside, always use a stop loss order and always have an exit strategy if the correction and the downside doesn't happen during the time period you're giving the trade to work. I hope this is clear. Moving on to the next question. Thank you for your efforts putting these videos together. Look forward to seeing them. I appreciate you suggesting some dividend stocks. I am a Canadian investor. Any likes or faves on the Toronto Stock Exchange? Happy holidays and Merry Christmas from my family to yours. That goes to you as well. And during the coverage of that question where I gave recommendations of dividend stocks, I recommended some bank stocks such as JP Morgan, Bank of America, Goldman Sachs, and Morgan Stanley. There is another name, a Canadian name, the Royal Bank of Canada. Here you have a name that pays about 4% dividend, and it will benefit from the surge in interest rates, specifically in U.S. Treasury rates. Furthermore, it is recovering and recouping all of the losses since the COVID-19 correction. Furthermore, the Canadian government is handling the crisis way better than the American government, meaning that the likelihood for defaults and more scarring to Canadian banks is less likely when you compare it to American banks. So again, the ticker RY, the Royal Bank of Canada, is a name that you should be interested in. They pay 4% dividend. It is a solid, reliable dividend, and it's a name that I would be very interested in adding to my own portfolio in 2021. And here is the last question of the day. Will this market ever truly correct itself? Will the new year bring a dip? Oh, well, sitting on cash for now. Well, that might be not a bad choice at all that you're sitting on cash. I'm sitting on about 70% cash in my portfolio, a little less than 70, but it is a significant amount. And of course, I'm waiting for a shorting opportunity and buying the dip in 2021. You will certainly see a dip. That is a minimum, if not a crash in 2021. But remember, why is the market so frustrating right now and we're seeing the market drifting higher and higher every day? What is the incentive to sell for retail traders right now? They've been lucky. They've been watching their portfolio grow every single day. What is the incentive at this point and this time for them to sell. They have the vaccine optimism. You read the comments when we were talking about Chris Sacca. They have the vaccine optimism, they have the Fed optimism, they have the stimulus optimism, they have the fill-in-the-blank optimism. It doesn't matter. They have no incentive to sell. And that is usually the psychology of retail traders during cycles of boom. They don't know when to take their profits because they get greedy. It's simple human psychology. They want more and more and more. What will trigger a sell-off in this scenario? If there is an exogenous event that will force a sell-off. And that could be many events, some market related, some not. But once the selling starts, you will see a waterfall like scenario, specifically if it's a heavy sell-off due to the fact that the majority of these trades and investments are done via margin borrowing. We talked about margin borrowing at all-time highs, meaning if we do have a correction and a crash, a lot of margin calls are going to start to get triggered and we will see a domino effect crash. Now, me and you sitting on cash, we want to seize the first signals of this domino effect crash, and we want to place a lot of capital to short the market. And that would be a legendary trade, one of the most profitable trades that you've ever made. I remember 09, placing a short in 08 and how profitable that trade was. Again, in Brexit 2015, perhaps we have another one coming in 2021 where you're going to make a ton of money. And then there's going to come a point where the bleeding in the stock market will become very noticeable and we will see further action from the Fed to calm down the market and perhaps prop it back up. That would be the dip to buy and to accumulate a long portfolio of stocks once again. It will be different than usual because the economic conditions are going to change, but that is a subject for another discussion. For now, all you need to know is we're not seeing a sell-off because there is no incentive psychologically for a market participant to sell at all. At all. There is no incentive for them to sell besides taking profits. Do they know how to take profits? From history, we know that retail investors and traders do not until they are forced to sell. So I hope that answers your question. And the last point I want to bring before I log off is if we do not see significant activities in the next few days, there will not be a full episode video. Unless, of course, we see a crash or something significant, then I will make a full episode covering the market per usual. Aside from that, I do have certain videos such as risks that I see in 2021, my stock picks for 2021, and a year review for this year. So these 3 videos will be uploaded in the next 3 days until we hit the new year and we will resume the daily episodes. That being said, that's all I got for you today, and I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.